The U.S. and China have entered a new chapter in their economic relationship now that phase one of the trade deal has been signed.
China has made substantial and enforceable commitments regarding the protection of American ideas, trade secrets, patents, and trademarks. But they're doing many more things in phase one than anyone thought possible.
But questions remain about the economic impact of the deal, and our own Steve Liesman, now officially being introduced here, joins us.
This is
with more than just the gossip behind the scenes.
A really complicated deal to game out, but views on the phase one deal that I'm reading so far range from guarded optimism to outright skepticism. Let's take a look at the good and the bad. Most tariffs remain in place. Almost every economic report I've read starts with that fact, the idea that those tariffs are still there. China will be upping purchases of U.S. goods. Questions about how that works for the U.S. economy. Confidence and capex could both rebound over time as a result. However, tariffs can be reimposed, so maybe there's some limit to how much confidence comes back. On the upside, this deal looks like it's a step towards freer and fairer trade with this dispute resolution in there. Barclays writes this. This is interesting to me. The reduction in U.S. tariffs is fairly minimal and raises the risk that trade volumes between the U.S. and China continue to slow. And business spending by U.S. firms remains subdued. The absence of a further escalation in protectionism is likely to have some benefits for business and household confidence. Because the tariffs remain in place and Chinese purchases may not all represent new business for U.S. firms, not seeing much in the way of upgrades to the GDP for the United States. Some forecasts are upping it by 0.2 this year and 0.1 next. The GDP story in 2020 is going to be this. Continued negative effects of those tariffs from last year working their way through the economy against the potential upside of the phase one deal, Andrew.
Okay. Thank you, Steve. And we should say a programming note, you don't want to miss this. At the top of the 8 a.m. hour, White House Trade Advisor Peter Navarro will be our special guest. Never one to hold back. What's your big question for him, Steve, by the way?
On the spot here a little bit, Andrew. I would ask him about the idea that he made this big deal about steel tariffs having this big effect. I looked at steel employment in the steel industries. They're all negative. You have not had the bounce.
There were some news about layoffs in the steel industry.
Layoffs in the steel industry. He says this has been a big win for the U.S. economy in terms of this. I would ask him if he's happy now. I think Navarro won the day here. Yeah. Because, and look, depending upon your orientation here, the president may have negotiated the best trade deal in the world in the sense that he changed the facts on the ground. The tariffs remain in place. Right. And he got China to the podium to sign a deal.
Well, Bannon and Kyle Bass were both saying this. So they were much more effusive about the actual deal because the knee jerk is that we're not going to get anything and it's just a,
right.
sort of a truce where we didn't really get anything. They think it was a watershed.
But Joe, the problem with my sort of signing on to that effusiveness is the tariffs remain in place.
I know. Did you read
and that is thought to be
you read
negative.
Navarro's piece about tariffs?
I read Navarro's piece. That's what caused me to look at steel employment, which has been negative. But I also read the Journal today, which
because
is
in terms of inflation
or
certainly in terms of its impact on the stock market, none of the worst case scenarios came to pass.
I don't think that. I think the effects of the tariffs have been underplayed in terms of the negative effects, Joe.
Certainly by the stock market.
Not by the stock market, but if you think about the idea that we were going to do 2% growth with a 3% funds rate and a declining balance sheet, we instead did 2% growth with a 1.5% funds rate and an increasing balance sheet.
But at the same time,
a lot more stimulus
people like you have been arguing for years.
But
people have been arguing for years that 2% is the most we can do with productivity and population growth where we are. So why do you expect us to do 3 and then not do it?
We need a lot more stimulus to get there in the first place, and manufacturing has.
But we can't. You're saying that the best we can do is 2%.
Yeah.
Okay, so when we do 2%, that shouldn't surprise you because you said that was the best we can do.
I actually had said, Joe, we can do better.
Okay.